From Orange County and the campus of Chapman University, this is the Chapman Business Report.
The modest recovery continues apace, but will the modest party be spoiled by rising wages, maybe other factors, and whatever happened to the middle class? A couple of the topics we'll take up this segment of the Chapman Business Report, joined by Esmael Adibi. I'm Pete Weitzner. Essie, of course, the longtime economist here at the Ardress School for Business and Economics. You forecast 4 months ago this modest recovery continuing and maybe improving a little nationally, a little more in Southern California. So 4 months later, anything that surprised you, thrown off your forecast?
Not really surprised, but there were a couple of factors affected the first quarter. You know, there's no question. We saw the growth for the whole year to be about 3%, which, if it happens, that's the best growth since, beginning of the recession.
Would actually constitute a slowdown, because considering the third and fourth quarter,
but we always look at the average.
Right.
We average for the year. If it comes in 3%, that's the best.
Since the recovery started.
Since recovery started, because we did have, you're right, some quarters we had 4% growth, but we go for whole year. Now, what really changed a little bit, which I don't think is important, it's not going to affect or change the direction of the forecast, is what happened in the first quarter. Let's name a couple of factors that came out. The biggest one was the weather. The cold spill is exactly carbon copy of what happened last year.
Right.
We had the cold freeze, so basically consumers didn't come out shop. Some of the production was delayed, so that has a slowdown.
Not to be cynical, but there's nothing good that comes out of that. I mean, we've talked in the past when there's disasters, you get reconstruction activity.
Yeah, but
nothing good comes out of it.
Nothing good comes out. And if you don't go eat restaurant, you don't go twice to make it up. So it's a lost sale. And then second was the strike. What happened at the port, in Los Angeles and the entire West Coast, that negatively affect inventories, jobs in transportation, and a whole bunch of multiplier effect. So these two factors, obviously they're negative, and at the same time, oil prices dropped significantly from $100 to almost 50, actually below 50. Now that should be positive, which means it's going to increase potential consumer spending. But because of the cold weather, nobody really came out and spent. But at the same time, we see some job losses kicking in those states that disproportionately are exposed to oil production. So overall, I think the first quarter is going to be a big hiccup. When the growth comes out, it could be 1, 1.5, 1.25%.
Sure.
But we believe that the second and third quarter, similar to last year, is going to make up for it. So the growth could be closer to 4% the next 2 quarters. So it's going to get us back on track for about 3% growth.
I want to get back to the port situation because it points up this push for higher wages, whether we're talking at the lowest level, minimum wage, or these are good-paying middle-class jobs, but they got an increase in their contract. But I want to go back first to your last point about, it seems to me increasingly people are talking, economists, about lower oil prices and hence lower gas prices, even though they've moved up some, as much of a negative as a positive.
No. I don't know. We don't believe so. Net, lower oil prices, lower gasoline prices, positive for the economy. There's no question. Look at it this way. Let me just throw a couple of statistics. In California, we use 14 billion gallons of gasoline, 14 billion annually. So let's say it goes down 50 cents, which is now it's down 70 cents plus previous year. You're talking about $7 billion, which is not going to be spent on gasoline. And remember, when gasoline prices go up and we spend more money, that money goes somewhere else.
Right.
When gasoline prices go down and it stays in our pocketbook, potentially it's going to be spent here. So it is extremely positive when you see gasoline prices down. Think of transportation of goods, how much lower cost is going to be there. Now, there are some negatives, there's no question. The biggest negative is for states such as Texas, North Dakota, Colorado a little bit, Utah, and Oklahoma. These are the states that obviously they relied quite a bit on oil and natural resources. And the decline in oil prices is putting some of those rigs out of business. So it's going to create some job decline in those sectors. But net effect, there's no question.
Globally?
For global economy, it's fantastic. What's wrong with that? Look at it this way. Look at Germany. Look at Japan.
Look at Russia.
China. Whoa, forget about Russia.
Not that we're terribly sympathetic to Vladimir Putin.
I'm not.
But
Russia would be like Texas. It's an oil-producing country. Russia, Saudi Arabia, Venezuela, Iran, they're going to be in trouble. There's no question. But look at the Western world. Look at Germany.
Which need their oil from, right.
They practically don't produce much of oil. So lower gas prices is good for them.
So going forward, if oil settled in at $50 a barrel?
That's a good news. That's a very good news for our economy and our trading partners.
With Iran possibly coming back online, the treaty's just been signed, I mean, or not even signed yet.
Yeah, but first of all, at least the president is saying that we're not going to lift the sanctions immediately. They want that.
I'm just saying down the road.
Down the road, sure, that we would get potentially more supply, and again, that's a good news. But we don't want to talk about politics, but all of this can change just like that. If Saudi Arabia announces that we're not going to produce 10 million barrels, we're going to cut it to 7 million. The whole thing is going to change. So it's not as much of an economic than politics. There is one economic factor in oil market. The value of the dollar has increased significantly. And whenever dollar increases, then oil prices, you know, basically go down. Gold prices go down because they have inverse relationship. That's the only economic factor. Otherwise, the rest of it is exogenous. It's basically Saudis announced that, well, there's a glut and we're not going to cut. Right. You guys cut. So if they decide for some reason, you know, to go through that cutback, we're not going to stay at 50 and it goes back immediately to $77, $80 a barrel. But at least what we're seeing now is a stable oil market. The chance of it to spike up is not there. And overall, we see it as a positive news for almost every consumer in the U.S. One more point, I'm talking too much about the oil market. We have little negative impact in California. Remember in Bakersfield and Kern counties, we have some production going on there. So we would get a little negative there, but compared to size of our economy, it's not as important as North Dakota or Oklahoma.
Right. So nothing of a macro level, on a macro basis, is keeping you up at night.
No, I'm not worried. We're always worried about unexpected event. But like this quarter, as I mentioned, these three factors that I mentioned drag down the growth. But I think there would be some making up coming in. Remember, still consumers didn't come out and spend that savings. Now, they're not going to spend all of it, obviously. Some of it is going to be, you know, saved, some of it paying down debt. But even if they spend 1/3 of it, that's very good news for retailers and consequently for manufacturing chain.
Okay. Well, you mentioned retail and the big ticket items. It's been an excellent run for you know, for auto manufacturers, for car dealers. They can continue to have, you know, top 5 years. Yeah. But it seems that the consumers are still mostly getting those big ticket items, what they have to have, and discretionary spending.
It didn't come back in. Yeah, it didn't come in. But if you look at auto, let's talk about the auto. The sales is going at the pace of 17.1 million cars for the year, obviously. That's the highest level that we had. Of course, one factor explaining that is age of cars on the road. We still have very, you know, old cars on the road, almost 10 years. So that basically means some replacement. And at the same time, people's disposable income is picking up. The job creation is bringing some people to the job market.
And the low level of interest rates makes affording a car.
And I hate to say it, some subprime lending is going in the auto sector. So all of that is really helping auto sectors. But I think that gas saving, most of it is going to show up in retail market on the low end of the market. Because the people who have low income, relatively speaking, everything that they save becomes spending. They have higher marginal propensity to spend than somebody who's making a couple of $1 million. For him, gas saving is not really relevant.
Sure, and that's one of the arguments. That's a good segue into this debate about the merits of raising the minimum wage versus whether that could, sure, it's more money in people's pockets, and on the lower end, they're much more likely to spend a savings, a tax savings, or an increase in wages than on the middle or upper end. But of course, versus that there could be less jobs. And it's from the other day, McDonald's raised, well, on their company-owned stores, raised from 9 to 10. LA will not do business with any contractor, Los Angeles County, I believe, unless they pay $15 an hour. San Diego raised their minimum wage.
Yeah, there's a movement, nationwide movement.
As an economist.
Yeah, okay.
As a cold economist.
This is a very tough issue to talk about, and there's big controversy. First, let's teach little economics. Every time you make something more expensive, there would be less of it used. That principle is true.
So my quarter pounder is going to go up.
So no, first, the employer, if they have a choice, they would pass on all the costs, as you said, to the consumers. If they don't have a choice, then they try to reduce their cost and maybe to rely less on workers. So who gains, who loses? Those who get it, the $1, $2, $5 increase, they're going to benefit. And by the way, let's not forget, even if in Los Angeles County or Orange County you make $15 an hour, you're poor. So
you're well below middle class.
Exactly.
Which average rent's $2,100.
Of course. But if you get that $2, $3, sure, at margin, you're making some improvement. But at whose expense? The expense is the consumers who are going to pay for it. And if they don't pay for it, then businesses are going to basically substitute machinery for workers. So somebody who wanted maybe to work at $9 and now at 11 nobody hires him, he would be the loser. So there is a big, big debate on this, but let's not forget that income gap in the country has grown. And the way people are basically approaching it is let's push these guys up by mandating higher wages. I would like to see we spend more money on education, because if we spend money on education, that's the only way somebody can improve his living standard and his earning power.
Education such as in training by the private sector, which is drastically down. They used to, the private sector used to spend a lot. Yeah. Or are you saying money, wherever it comes from, to institutions to train, to colleges?
Both can be done. I mean, look at how it works. Starbucks just recently announced that they're going to send their employees to college and they're going to pay for it. I mean, that's something that you haven't heard of. But so businesses are going to be participating.
I think it's going to be an online education, but nonetheless,
but it doesn't matter. I mean, they're getting college degrees. So, and at the same time, like, we have to help people who are needy, really need the money, to go to community college. Like the president suggested, make community college free. I don't like that idea. We should make it free for needy kids, not for everybody. But if we do these sort of things over long run, we can help more the income gap than just pushing the wages higher and higher. You know, just very quick anecdote. I was in Europe and I went to a McDonald's. This McDonald's, 24 hours McDonald's, didn't have any cashier. Nobody was standing to taking order. It's amazing. You just go to a machine, you order, and you put your card, they give you a number, they call the number, hand it to you. If we force businesses, you know, with higher wages, eventually what they're going to do, they're going to replace machines for people. And that is a bad news.
We're going to talk to the boss about the level of prices these days, home values, stock prices, if the Fed's in a box, where it goes from here, other things on our next segment of the Chapman Business Report. Thanks for watching.